we have one more central bank that is menacing investors. One more before the calendar turns to 2024. So should we be concerned? Or are the fireworks canceled until the new year begins? Well, not everything is quite so simple, unfortunately. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro, and we're focused on the Bank of Japan as we wind down the second half of this month and begin the first holiday uninterrupted week before the calendar turns to 2024. Now, to expect volatility out of the Bank of Japan is a bit unusual. Central bank has been doing very little different and, in fact, skipped the entire global rate hike cycle that occurred all through the tail end of 2021 and into the middle, at least, of this year, because it felt that despite inflation's rise, there wasn't anything for them to do. But now, and unusually, the market is very focused, laser focused on what this central bank might do because, again, a year after we did this just about exactly a year ago, we are faced with a situation where the Bank of Japan is thought to perhaps be looking at some sort of a reversal of decades of monetary easing. And so what we're going to do here is we're going to take a look at why it is that the market is suddenly hopped up on this kind of speculation and what it is that investors fear might be ahead. So the first thing that we are going to do here is we are going to take a look at what is expected, what the markets think the Bank of Japan might do here, why they think that, and then what the actual implications for taking a trade on all of this might actually mean from a tactical perspective. So let's begin here with, first and foremost, the expectations. So as we can see here, the markets don't envision any kind of a change in Bank of Japan policy this go-round. So the focus ostensibly then likely to be on the guidance, and in particular, the policy statement, as well as the press conference with BOJ Governor Kazuo Ueda after the policy announcement for what is likely to be the main sort of catalyst here. So if we look a little bit further out down the sort of projection for the outlook here, we can see the possibility for a rate hike. And note in the final column here, the average rate move column on the far right side of the table here, ARM, it's not 25 basis points as it is for most central banks. It's 10, and that's a legacy from the last time that the Bank of Japan moved rates, which was a very long time ago. But in this context, when we say one cut or one hike, we're talking about a 10 basis point move, not a 25 basis point move. Now, you can see the first hike is all but fully baked in at this point by the April meeting. So 92 chance. We can see in the number of hikes cuts column, there's a cumulative probability of 92% that we are getting the first 10 basis point hike to occur there. Now, that would take us from rates at a negative 0.1% into essentially a flat setting. We can see that we have, it looks like, two of these on the menu for this year, with a 69% probability for a third by October, which essentially means that we have space for perhaps something like 3 rate hikes this year, as far as the markets are concerned. If we take a look at what this looks like as a sort of pathway, we can see here we are at negative 0.1 currently. Within about 6 months, we're essentially out of negative territory. Somewhere between 3 to 6 months is where we cross the zero line. So somewhere toward the end of the first half and into the second is where we get to zero. A year from now, we can see we're at 19 basis points. So call that a cumulative almost 3 rate hikes. So 10 to get us to zero, 2 more hikes. So a cumulative 20 more basis points to get us to almost where we are here. Then we see that in 2 years' time, we get 2 more hikes. In 3 years' time, we get maybe 1 more. So we're looking at rates at this point that are peaking at about 0.5% in 3 years' time. So by no means is this an aggressive sort of pathway that's being envisioned here at a time when the Fed raised rates from 0 to essentially 5.5 over the course of just starting in March of last year and into July of this year. So let's call it something like 16 months. So this is by no means an aggressive tightening cycle that is being envisioned here. Furthermore, we can see that since the last time that the BOJ met, which was the end of October 31st here, you can see that in the big dashes here, the curve has actually become a little bit less hawkish. So it's actually moved down some, in particular from about the 1 year mark onward. So the pathway higher seems to have become shallower as we look out beyond a year from now. So the market is geared up for some tightening. They're not geared up for anything dramatic in relative terms. Nevertheless, speculation that Japan might actually be looking to end their expansive easing has had a tremendous amount of market moving potential. We can see that just over the course of the past several weeks. Now, note here, this is a chart of Japanese yen futures, and we can see in particular on the 7th of December here, a violent spike higher, and that is almost harder of a single day move than what we saw a week later from the Fed, where one might argue the move was more justified, or at least better supported fundamentally. So what was it that generated this outsized move? Well, first we had a speech from Bank of Japan Deputy Governor Ryozo Himino, and in parallel, semi-annual testimony from BOJ Governor Ueda at the Diet, which is Japan's parliament. So this was a bit of a 1-2 punch. Ueda, in that testimony said that managing policy for the central bank will become more challenging after the end of this year, seemingly implying that next year there's some kind of a shift and that there's a degree of timing here linked to this December meeting, that after this meeting, things get difficult, implying that maybe there is a triggering of something at this meeting that the central bank envisions. At the same time, almost, Ryozo Himino, the deputy governor, gave a very closely watched and very loud speech arguing that lifting interest rates would not be nearly as harmful as feared, that essentially Japan can get off negative interest rates without breaking anything. And taking those two pieces of guidance together gave us that sharp yen rise that you see here, because essentially the market figured, well, the BOJ governor is telling us something is about to get touched off at this December meeting, maybe. And then at the same time, his deputy is signaling which way a change might go. So the markets are understandably hopped up on speculation, in particular about this meeting. As a matter of fact, we can see that the implied volatility for yen futures in the options market is at this point higher than any other major currency going into this announcement. The yen, of course, then has a subsequent further jump when the Fed comes out and essentially owns the idea that they're going to be cutting rates next year. They don't quite say it that explicitly, but for the first time, they signal that they feel rates are already, if not at the peak, then close to it. And the latest summary of economic projections envisions three cuts that Fed officials themselves are penciling in for next year, which is, of course, not nearly as dramatic as what the markets expect. They're aiming for 6. But nevertheless, the Fed has basically owned the end of the tightening cycle. And so then the dollar sells off in general, and that gives us a round of anti-dollar currency gains. The yen, of course, is not immune, and so the yen goes up as well. As a matter of fact, it has a particularly large rise, and we'll look at in just a moment why that rise was so particularly outsized and how that fits into this narrative. But first, the key question is, will Ueda and Himino actually follow through? And is their signaling, in fact, what they intended? Did the markets read them correctly? Or were they saying something much more milquetoast, much less controversial than what traders seem to extrapolate from their comments, as we can clearly see they did in the price action? The first question is, does the Bank of Japan actually need to tighten monetary policy? And the first sort of obvious thing is that their target for inflation is 2%. And as of October, which is the last inflation reading that we have, we'll have November later this week. But for October, we were at 3.3% on headline CPI. That is the 19th consecutive month above the BOJ target of 2%. So one might conclude, well, indeed, the Bank of Japan needs to do something here. Inflation has been running hotter than the target for over a year. On the other hand, the makeup of the inflation warns that perhaps not all is as it seems if we looked at just the headline number. That massive yellow area that you see there on the chart contributing the bulk of the uplift in inflation is food. Japan consumes primarily imported food. It produces less than 40%, as a matter of fact, of the food that it consumes. So most of this is imported. Now, if we consider that the Bank of Japan was the only central bank of the major ones that didn't follow the Fed's tightening cycle that began last year, and the yen was by far the biggest loser amongst the major currencies last year because all the other central banks were raising rates and thereby making it increasingly unattractive to own yen, which pays nothing, as opposed to other currencies which increasingly pay something and more. It makes sense why imported food would suddenly become much more expensive in yen terms. If the yen is getting crushed, then the purchasing power of Japanese consumers to go out and get imported food is diminished. If they have to buy things from producers that accept payment in currencies other than the yen, the sort of simple underlying thing there is the yen's purchasing power in buying from those producers declines with its value. So the price of food is understandably going to jump. Now, if we were to factor food out of the equation, we find that Japanese CPI is actually less than 1%, 0.6% rather than 3.3%. And so the sense of urgency here is arguably not there. And as a matter of fact, we've heard now repeatedly from Bank of Japan officials that what they want is domestically founded, sustainable inflation if they're going to change policy. As for food inflation, it's arguably peaked already. What we have here is a situation where the global story for the price of food has been one of a strong rise post-COVID, as we've seen with so much of the global economy. After COVID, there were supply chains that needed to mend. There were significant asymmetries in which economies reopened when relative to others and how that impacted the sourcing of goods along supply chains that felt ironed out before the pandemic, but suddenly looked like they were broken thereafter. And suddenly there were shortages and, of course, price gains. So we can see that as a global dynamic, but we also see here that the transmission mechanism from the global price of food to that showing up in CPI numbers, in inflation numbers, seems to be about 7 months. So in the orange here, you have a United Nations index of world food costs, and then in the dark gray there, you have global CPI. You lag global CPI 7 months, and it seems to line up with what's going on in the trends for food inflation. And so you find here in that the price of food has continued to fall. You can see the orange line here extending past the gray one. You seem to have a case to be made that global food inflation will continue to fall as it has been falling. As a matter of fact, looking back here at this number for Japan, we can see the yellow bars have already somewhat crested, or at least have the appearance of cresting. And so there seems to be scope for food inflation to continue to work its way out of the equation, which should bring the overall numbers lower without the BOJ really doing much of anything. The second part of this story is, of course, where speculation about this began to really swirl, which was exactly a year ago with the Bank of Japan's December 2022 meeting. And there they pointedly weakened their commitment to one element of their dovish policy mix. They have a policy called yield curve control. And here, what they do is they commit to a 0% cap on the 10-year government bond yield. And when that cap is breached, they've created thresholds saying we'll allow it to go above the cap this far, but not further. And we will enter the markets and essentially bully them in the opposite direction and defend that level by essentially buying bonds in the market and thereby pulling yields down back within those bounds. As of December, right ahead of last year's December BOJ meeting, the threshold was 25 basis points. This is where things get interesting. So the gray line you see here is the 10-year overnight index swap. So that's where the markets believe the 10-year rate in Japan should be. The orange line is the actual yield. So that's the thing that the BOJ is capping. In seeing the spread between them, we see the disconnect between where the market is pulling Japanese rates and where the BOJ is trying to restrict them. Now, we can see in the gray bars the level of disconnect. That's the spread between the gray and the orange line. In the red is the yen itself. So notice what we see here. And of course, here's December of last year. So the spread is 0 up until shock of shocks, the beginning of 2022, where the Fed begins its tightening cycle. As soon as it does, expectations for rates in Japan, where markets think the 10-year should be, they go up and they veer away from where actual Japanese government bond yields are because the BOJ is trying to hold them down. Here's 25 basis points, so that's the cap allowance on this. Notice, as we get over here, the cap is reached. Just as we get into December of last year. And that's because when the Fed raises interest rates, it raises them everywhere, pretty much. We didn't need the Bank of Japan to do anything, as we can clearly see here, for even the orange line to go up. It's already going up as of here. And that's because when the Fed raises rates, it raises the cost of borrowing dollars, and the dollar is the global unit of commercial exchange, bar none. There really is no competition. According to the Bank of International Settlements, 88% or so of global monetary transactions are settled in terms of U.S. dollars. Make U.S. dollars more expensive to borrow then, and you make all economic activity more expensive to finance everywhere, not just in the U.S. Because financing it invariably means borrowing dollars at some level. So, as interest rates are pressured higher by the Fed, they veer away from where the BOJ is trying to cap them, below this 25 basis point mark. And that starts to stress this system and put the BOJ basically in direct conflict with the Fed. The Fed is pulling rates higher. The Bank of Japan is trying to keep them capped at 0 with a threshold of 25 basis points. Now, obviously, this is not a good spot for the BOJ to be in. They don't want to be fighting the Fed. It isn't obvious that they could have sustained it. And so what they do in December of last year is they widen the band to 50 basis points. the yen, of course, jumps. There it is. So here's the yen. It surges on this. But then, of course, the Fed keeps raising rates. So it comes right back down. But here, notice, the system is stressed. And what the BOJ does is it says, now we'll allow it up to 50 basis points. So we'll increase the cap from here to here. The spread never even gets to test it. Not really. It tops out at 46 basis points on a monthly basis. Well, now that the Fed has signaled that it's done raising rates and yields have turned down, as we can see here, certainly in the US, but again, you can see it echo in Japan. The pressure isn't there even to the old cap of 25 basis points. And the new administration at the Bank of Japan, Governor Ueda took his post in April of this year. The cap has been further increased from 50 basis points to now 1 full percentage, or 100 basis points. So at this point, the cap is here. This spread would need to jump from here to here in order for the markets to get stressed about the viability of this policy again. And with rates coming down, things are going the opposite direction. You can see we've now fallen to 21 basis points on this spread. And we're shrinking. So the pressure for the Bank of Japan to do this for the sake of the viability of yield curve control, the need for the Bank of Japan to go and try cutting this this effort because they can't sustain it because the hawkish Fed is pressuring them is simply not there like it was before. Add into that a weak economy. The latest GDP numbers gave us a contraction of 2.9%. That's for the third quarter of this year. That would make it the weakest that we've seen of the Japanese economy since COVID times. By a bit of a narrow margin, we saw in the first quarter of 2022 growth shrink 2.4% at an annualized rate. That was this. But clearly, things are not going well here. And so the need to tighten, which already seems to be relatively flimsy, is further made weak as an argument because the economy looks less resilient, looks less able to onboard that tightening. It is already suffering. Looking at PMI data, which gives us a little bit more of a timely perspective on how things look going into the fourth quarter, we can see in particular the composite of manufacturing and services, the dark gray line there in the middle, back into growth territory. So this is in the logic of PMIs as ever. So above 50 is growth. 50 itself is neutral. Below 50 is contraction. We can see that we were in contraction territory. We've recovered out of it in December and November, but only just so. We are at 50.4 as manufacturing shrinks at an accelerating speed, but services picked up a bit. And so what we seem to have here now is a little bit of growth. There was a contraction in November, but December saw a bit of an expansion, largely because the service sector picked up to its fastest growth since September. But at 50.4, considering 50 is standstill, situation is very weak. We are a hair better than fully stalled. So again, the resilience of Japan's economy in the face of easing seems, or in the face of tightening rather, seems tenuous at best. Then there is the likelihood that we will need some sort of a significant tightening cycle or some sort of an escalation of the situation. And we are reminded why we are only seeing maybe something like a positive 20 basis points on the target rate by the end of next year, and then maybe something like a 50 basis point rate within 3 years, which is obviously a far cry from what's going on elsewhere. And that is because weak inflation is essentially baked into the demographic cake for Japan. Inflation, and then, of course, in parallel, interest rates have been falling since the early 1970s. And what that's comported with is an aggressive decline, first aging and now outright shrinking of Japan's population. At this point, Japan has the oldest population on average in the world. And that is going to contribute to weaker demand. Generally speaking, the peak age for spending is about 45. Right around that time is the peak for when people really spend money on household formation. They begin to form families, they begin to have children. All of that is a considerable outlay, of course. All of that spending tends to peak on average between 35 and 55. So call it 45 as a point in time. Japan is past that point already. That, of course, means, all else being equal, less demand. If people are, as a population, past the point of peak spending, well, then there's going to be less of an upward pressure on the price of goods because, put simply, there is less money chasing the same amount of goods as opposed to more, which was, of course, the post-COVID issue globally to begin with. So we're in a situation in Japan structurally where for a very long time yet, the aging population will mean weak demand. That weak demand means there's really no meaningful upward pressure on inflation, and so there's really no reason for interest rates to go up. As a matter of fact, the very violent attempt to get inflation going with monetary expansion has largely left this dynamic intact. It's really done very little. That's in the yellow here, the dramatic expansion of the BOJ balance sheet, the vast asset purchases that they've made to try to inject more money into the economy to get people to spend more. So much so that now the BOJ balance sheet, their asset holdings, are hovering around 130% of GDP. So they are 130% of the size of the economy, 1.3 times the economy of Japan. Total output. So the story here is largely stuck from a demographic perspective with low rates and a dovish monetary policy for probably decades to come until the demographic picture meaningfully turns a corner. But what this does, other than keep the BOJ in dovish mode, is make for a very interesting relationship between the yen and interest rates. And this is, of course, where the trading opportunity lies. So we can see here, there's a very strong inverse relationship between the yen and interest rates globally. In the dark gray there is an average of 10-year bond yields for the top 4 major currencies, the US, the Eurozone, the UK, and Australia. Obviously holding Japan aside, the top 4, not Japan. And inversely of that, as we can see, is how the yen performs. And this is like because of these demographic forces that have kept interest rates so low for so long. It starts to be a money-making proposition if interest rates are going up outside of Japan to borrow in yen, which costs next to nothing, to then take that borrowed yen and buy assets that yield more, to then take those assets and extract that yield differential as an income stream. And as long as the price of whatever asset that's higher yielding that you bought is not falling to a greater extent than the interest you are earning on that asset, well, then you're making net income just by holding. Because the interest you are paying on your yen loan, which is next to nothing, is completely offset by whatever interest you may be making, let's say, on owning higher yielding or higher dividend stocks or higher yielding corporate or even government bonds, as long as they're not Japanese. And of course, what have we seen since the beginning of last year? We've seen a blistering rate hike cycle, making interest rates more attractive outside of Japan. But of course, now the process has reversed course. Now everybody's looking to cut, and we can see that yields have started to fall, and the yen has started to rise. This is a dynamic likely to carry through the rest of next year as other central banks, Fed in the lead among them, cut rates. All of them are expected, from the Fed to the ECB to the Bank of England to the Reserve Bank of Australia, New Zealand, Canada. All of them are expected to cut rates to some extent next year. So if the Bank of Japan comes out today and disappoints hawkish speculation and the yen falls on this basis, that doesn't so much look like the start of a new downtrend or the reversal of the up move that we've seen since about the beginning of November, but really mostly in December. So we can see right here. Rather, it is perhaps a buying opportunity at a more attractive level. Because if the yen is to go up in earnest next year, it won't be because of what the BOJ does or doesn't do. It'll be because of the global interest rate environment that's turning back in the yen's favor. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan. I'm back on with Chris for Futures Power Hour on Fridays. I'm on with Tom and Tony for First Call on Sundays, opining on the platform formerly known as Twitter at Ilya Spivak, and writing for the news and insights portion of tastylive.com. Thanks very much for joining. Good luck out there. We'll be back tomorrow. Take care.